So if you're watching this on YouTube right now, you realize I have changed my location. We finally have a house, so I'm super excited, and I have a place of consistency, stability, and more importantly, obviously for my daughter. And I am ready to take off and give you guys so much deep value today with the podcast episode at play. And so if you're watching this on YouTube, the podcast is on Spotify, Apple Podcasts, anywhere, called Money on My Mind podcast. If you're on YouTube watching this right now, I'm going to answer Stephen Lundy's question. And I like to answer your guys' questions directly. If you guys want to leave a question for me to answer, feel free to put in the show notes below. So today's question is a really good one, and it's something I like to touch on every time there's rockiness in the stock market, which there is right now. New administration means change, which means fear, which means a lot of times rockiness. And so Stephen Lundy asks, is the market going to crash, and what is the best way to secure my investments? Should I move over to bonds? So Stephen, great question. This is a question that I get oftentimes. And when I talk to, obviously, a lot of different people, there's a lot of different times in the market where things are going good. Nobody's really concerned about their investments. Everyone's just trying to get rich. In the second anything gets rocky, volatile, or goes the opposite direction, which is down, people freak out and ask this question. And so I want to address this, and I consistently want to bring this up for reminders because I know not everybody sees every single thing I post, but I feel like I'm a broken record when it comes to this. In short, is the market going to crash? Let's answer this. Let's piecemeal this question a little bit. Is the market going to crash? I don't know. I don't think so, but I have no idea. And so I don't have a crystal ball, neither do you. But the thing is, you're really asking that because you want to build wealth. So let's understand where this question actually stems from is you don't want to make a bad move or lose money because you want to build wealth long term. And so regardless of what the market does short term, you're still going to win if you do things the right way and you walk through my frameworks I'm about to share today. And so I wouldn't overly be concerned about does the market crash, because it doesn't really matter when you have a long-term horizon and we talk about how we approach our finances. And the second piece is what's the best way to secure my investments? That just means that you don't understand risk profile, which we'll talk about as well. Because securing your investments means you're trying to tighten up and you're feeling scarce. That's not how you build wealth. When you educate yourself and expand yourself, you will be able to build wealth and not feel like you always have to save or secure, but you're building wealth, which is a whole different thing. You're playing offense, not playing defense. That mentality is going to shift your wealth building journey in a sizable way. And so I'm going to walk through data, but I'm also going to walk through frameworks and process today to answer this question. And then the last question was, should I move over to bonds? That might be part of the allocation that suits you. Bonds could be part of that equation long term, but ask yourself, did you feel that way when the market was riding high? My guess is not, because if you haven't, you're asking the question as if you don't have bonds currently, and this wasn't a concern 6 months ago when the market was riding high. So ask yourself, are you really truly equipped, Stephen, with an educational framework to help you survive long term? My answer to that respectfully is you are not. And that's why I'm here to answer this question. But that's also why I help people in Budget Dog Academy build wealth the right way. So if you're looking to upgrade your financial life and change your life entirely, this is a lifelong commitment to a 6-month program to get your finances right forever, and then also be part of a community for a lifetime. If you are ready to take that to the next level and you want to apply to work with my team to get you there, go in the show notes below and do the application process and meet with one of my team members to see if it's a good fit. If it's a good fit, we'll move forward on that call. If not, no big deal. We try to help everybody that we can. So this question is a sensitive question because people can really hurt themselves when they ask these questions. And in fact, the reason I'm so big on answering this question so many different ways and so many times is because I've seen people essentially self-inflict their own pain. Because naturally, if you are not educated in the stock market, you're going to feel panic when there's any bit of volatility, which is why I always jump to, I want to equip you to be empowered to change your life forever, whether I'm here or not. So all of my students that go through the academy know that by the time they're graduated, 6-month graduation, and they're with us for a lifetime, they don't need me. My best compliment is when they come to me and they say, man, you've done so much. And honestly, I feel like I don't need you anymore. That's exactly what I want to get you to. And I've gotten so many families, thousands, in fact, of families to feel that way about their finances. Why the mission is so big is because I want you to feel that way. I don't want you to panic every time the market gets volatile or every time the market in 2022, for example, goes down 20%. I want you to be able to withstand that, benefit from that type of market, and win long term. That is what I want for you, Stephen. And you, in fact, should be joining Budget Dog Academy today because I'm talking to you. For anybody else listening, if you had this same question, which I'm sure you do, you need to be in Budget Dog Academy today. Invest in your education and in your future today. Do not be cheap. Do not wait, because what's going to happen if you're asking this question, this is going to cost you millions of dollars. And I'm going to show you exactly why that is going to cost you millions of dollars. The first thing I want to go over is understanding how to build wealth and what it actually takes to build wealth. And I want to bring up what's called the wealth triangle. The wealth triangle, guys, super simple concept. Anybody can listen to this and understand this. So it's in layman's terms as well. If you are out there and you're all of a sudden right this second, I'm going to call you out. You feel like, oh crap, he's going to be talking about financial terms and I'm not going to understand it. I'm shutting off right now mentally. Take a pause, take a deep breath, and realize I'm about to change your life if you allow me to change your life. If you resent it, if you shut down, if you have an emotional reaction to me talking about the stock market, that is something I can't fix. But my behavioral psychologist within Budget Dog Academy can. And that's where you need to be if this is happening, if you have an emotional reaction to the stock market in any sort of way. Emotions and finances will never go together, and you will always lose if you constantly live and die by your emotions. And so even during good times, it's not a good thing to have emotions towards your finances, even when the stock market's riding high. The wealth triangle is really simple when it comes down to how to build wealth. This is the fundamental way to build wealth. It really, truly is. The first thing, you're going to be laughing at this one, is time. That is the biggest wealth building factor by a mile. No matter what else I say today, no matter what other tip I give you, no matter what other framework I give you, simply having more time on your side is going to help you win the most. And so somebody that's listening to this, that's older, in their 30s, 40s, 50s, whatever the case is, a lot of times people are like, is it too late? No, absolutely not. You can't change the past. Just realize you have a timeline that you have to get into the market with, and you can't wait any longer. So if you've waited, don't let this be a resistance thing where you get held back and you get emotional towards it. And you say, well, I'm going to self-sabotage, and because I haven't invested and I'm 45, I'm just going to not do it. That doesn't make any sense at all. That is a loser way of looking at it. And it makes me really angry when I hear people shut down because there's a little bit of resistance. The only way you're going to be successful, this is the truth, is that you're able to overcome resistance. There are people in my academy that have shut down due to Excel being too difficult. And I've had to walk them through an emotional conversation because Excel was too difficult. If Excel shuts you down, it's going to be really hard to win. I'm just going to be honest. You have to get mentally tougher if Excel holds you back from building wealth. If emotions hold you back from building wealth, you have to get mentally tougher. What I went through the last 3 years of our life built mental toughness. Dravet syndrome is no joke. Having a kid that has seizures is no joke. Having a 1 in 16,000 rare syndrome that affects every element of life is no joke. The chance that there is based on statistics, a 20% death rate by the age of 18 is no joke. I have to become mentally tough. And so I bring that up on the personal side because the stock market is no different. It is a personal connection to your wealth, and you have to find the mental fortitude within yourself to build wealth, or you aren't going to if you shut down every single time. And the time component is your biggest wealth building factor. It truly, truly is. And I'm going to show you the difference with actual mathematical examples here shortly. The second piece of this is contribution. Let me take a step back. The house I'm in as I open this podcast is, you see a different background. This is the first podcast I've filmed in my new house. For the last 2 months, with all the stuff we have to deal with Dravet syndrome, we did not have a stable place of living. We did not have a living condition that was suitable for our family. And the amount of stress and mental toughness we had to build in order to handle that situation was something I can't really explain. Losing a house due to mold and mycotoxins, putting another offer into a house to have a contingency upon a mold and mycotoxin test, and then it getting a positive test, which means the deal fell through, to feeling that we might have to move out of this entire area due to the issues that persist. Spending $250,000 that was not expected. There was a lot to handle in the last 2 months. We had to develop mental toughness. This is how you become successful. You have to deal with hard stuff to win big. That's just the reality. So if you're listening to this and you think this is a stock market conversation, it's really not. It's a bigger conversation of how you build wealth the right way, which requires mental toughness, which requires resistance training, which requires persistence, consistency. All of these other things that require you to be successful are things that aren't stock market related. They're literally life things that you have to build skill set wise. And if you want to build wealth, you have to focus on the things that get you wealthy, which are those things which are yourself. It has nothing to do with what the stock market does. That's an external thing. But if you educate yourself and you have all those other traits of a highly successful person, you're going to win big. You're really going to win big. And if you apply what we talk about today, you're going to win even bigger. So time is the biggest factor. So get in the market today as long as you possibly can. Number 2 is how much you contribute. Well, we talk about the academy all the time, Budget Academy, but also just building a systematic approach to extract as much free cash flow out of your situation as you possibly can. And you have the ability to do that. You have the ability to build an automated system, which all my students do, to find as much cash flow, but also not sacrificing your lifestyle. You want to live a good life. You don't want to just spend and save money as much as possible and just spend on all your, expenses throughout your life. You want to live a life. You want to build a life that fits and suits you. So the second one's literally just contribute as much as possible. I always say 15% of your gross income is a good starting point. If you're below that, work up to 15. If you're above that, work past 15. We started at 5%. We built up to 70% of our take-home pay as invested. So you can get there. It takes time and it takes intention, and it's very, very it's something you cannot just think about. You have to actionably do. You have to build a systematic approach that gets you to those numbers, and it's proven logic and math, not just emotion. So the third one is asset percent return. And what I talk about asset percent return all the time is ETFs and index funds. If you are in quality low-cost index funds and ETFs, total market funds, US-based funds, international funds, domestic funds, you're going to win big. VTI, big holding of mine. FZROX, big holding of mine. This is the total US stock market funds. Nothing special, but they're really, really cost effective, and they're outperforming 95% of actively managed mutual funds. That's a statistic over 20-year periods. And so I know I'm going to win with those guys based on history. So that's the wealth triangle: time, contribution, and asset percent return. Something else that you want to consider is the common sense approach of the market. So Steven's question was, is the market going to crash? What's the best way to secure my investments? Ask yourself what the market is first. What is the stock market? Most people think businesses, they think PE ratios, they think stocks, they think bonds, they think real estate. The stock market is you and I, my friend. Steven, we are the stock market. Your wife is the stock market. Your kids are going to be the stock market, or potentially are part of the stock market now if they're buying and selling goods and services throughout the United States. Your parents are part of the stock market. We, the people, are the stock market. So when you think of it in that term, in that, a little bit of paradigm shift there, is it's not just stocks, bonds, and, crazy financial bros talking about finance. It's you and I going to work every day to go to a company that produces a product that produces GDP throughout the country and produces goods and services to help you sustain a life. When are we going to go away? I don't know about you, but we've been here for a long time as a human race, and I don't anticipate anything bad happening to the human race anytime soon. Some people have their thoughts, but everybody always thinks it's the end of the world. You tell me when us as people are going to go away, that we aren't going to show up to work, that we aren't going to produce products and services, that technology and innovation aren't going to continue. I'd be shocked if it doesn't. Now, does the valuation, the stock prices temporarily change? 100%. But does the underlying workforce that we all are go away? Not necessarily. It only improves. It only gets more efficient. It only gets more innovative with time. And so until I know that human beings are no longer a thing and that the US stock market's no longer going to be a thing, I'm going to continue to invest in dollar cost average into the market for as long as I possibly can, no matter what the prices are going to do. That doesn't matter. That doesn't really matter. I'm going to share stats as well for you. So some other things you want to think about when you are investing. There are 4 things in particular that I think everybody should have fundamentally understood before they even start investing. Number 1 is invest in things you understand. The reason this question was asked is because you don't understand the stock market. And I just explained it in layman's terms, is it's you and I. You don't fundamentally understand the stock market, because if you did, or you just have an extreme disbelief in the human race, that's the other potential here. Invest in things you understand, because if you invest in something you don't understand because somebody else tells you it's a good investment and you don't fundamentally understand that, when times get tough, when things get volatile, when there's uneasiness, you're going to bow out. I don't want you to do that. I want you to be educated so that you're able to withstand that. Invest in things you understand. It sounds like grade school, but it needs to be talked about, because so many people are investing in things. They'll invest in a stock because somebody else says online, Palantir, and they're like, I don't even know what Palantir does. Or I'm investing in, I don't know, an ETF, SMH, because it's semiconductors, and I don't even know what a semiconductor is, but they just do it because they hear it's a great place to invest, but they don't understand it. And this is where education comes into play. The second thing is buy and hold low-cost index funds and ETFs. All this is, and what I mentioned earlier, is I'm going to always buy low-cost index funds, a total market fund, a international fund, a sector ETF, whatever the case is. I want to encapsulate the market. I don't want to choose and pick and hope for the best, the needle in the haystack approach with the individual stock. I don't want to play that game. I want to make sure I take the whole market, I put it in my portfolio. I think about the strategic locations. Do I want the US? Do I want the international funds? International is big. Do I want China specific? Do I want all international, essentially ex-US, the whole entire world? Do I want specifically India? Do I want Japan? Where do I want on the map? I'm a big believer in the United States, but the United States is not the only country in this world, although a lot of people think it is, especially now because the US compared to international over the last 10 to 20 years has been dominant. But there are ebbs and flows, there are swings, there are changes. And so as volatility occurs, are you positioned? Do you have the right risk profile? Do you have the right allocation setup to handle all the volatility that will occur? You can build a portfolio that just does the S&P 500. Totally doable. You go get FCROX, the total U.S. stock market fund, and it basically follows and tracks the U.S. stock market. Or you get FXAIX or VTI or VXUS, or not VXUS, VT, something like that, the total world, and you will track that specific market. But the thing is, with an S&P 500 fund that you're getting the 10% theoretical returns, you don't understand the context. That comes with a lot of downside. When there's a volatile market or a recession, that slides the opposite way. You don't get 10% returns. You get whatever the stock market brings you, which could potentially be negative 30% returns. Are you ready to handle that mentally, physically, emotionally? With your stomach, does your stomach drop when you even hear that? If you can't handle that, it's okay. If you can't handle $1 million going to $700,000 overnight, then just change your portfolio structure to where that $1 million isn't able to go to 700,000 because you have it positioned with a risk profile that makes sense for you and your risk that you're willing to take. And that million only can go down to 900,000, but you won't have as big of upside. Like anything in the world, risk management is the name of the game. Risk management is a trait amongst the highly successful that when operating at a high level, you will win big. But for those that are scared and fearful, they lack education, they lack resources, and they don't pay for help, and they sit in a fear bubble. They don't take any chance, and they don't manage their risk appropriately. They go into cash. They think it's safe. It's not safe at all. You're going to lose a lot of wealth. You're going to lose millions of dollars by doing that. And when you do that long term, it's going to hurt you substantially. Buy and hold low-cost index funds and ETFs. It's a group or a basket of stocks. So if it's the S&P 500, it's the largest US 500 companies at any given point in time. So those will change with time due to innovation. The third piece of the puzzle is DCA, dollar cost average, literally taking the same dollar amount, let's keep it super simple, and putting that in the, let's call it the VTI, which is the ETF for the total stock market with Vanguard. I'm going to put $500 into that every 2 weeks, every month, every week, whatever the case is. Automatically, I don't do anything manually. It's already set up automatically, no matter what the price of the stock market is. So when this question is asked, is the market going to crash? If it does, I'm still investing. If it drops, I'm still investing. Think about it this way. If I put the same dollar amount into the stock market, and let's say the stock price is $500 right current today, and I put $500 every 2 weeks. That first week at $500, I'm buying one share. Sounds good, right? Now, what if it goes downward to $250? That stock price goes from $500 to $250, but I still put $500 in there in 2 weeks from then. But the price has dropped significantly. Guess what happens? I buy 2 shares. So when the world panics, that's when you get rich. So when everything drops, it's just an emotional reaction to the stock market for, Trump's tariffs or whatever the case is pops out. All of a sudden, the market drops, but I still do the same thing. I'm making more. I'm actually accumulating more shares. That's why dollar cost averaging works, because then it goes back upward. And let's say it goes to $1,000 per share, but I put $500 in. Now I'm only buying a half. So as the market goes high, I'm buying less. As the market goes low, I'm buying more, which over the long haul, I get the better of the average of the market. This is how you win long term. You stay put, you create an automated system that does that for you, and you don't ask the question, is the market going to crash? Because it doesn't matter. Because as the market does crash, you get richer. 2022, I'll give you a good example. I've invested the most money I've ever invested in my life. The market was down 20%. Everybody told me I was silly. Look who's laughing now. The same story plays over and over and over and over. And until the human race is exterminated by aliens that are coming here soon, I'm just kidding. I'm going to continue to do exactly what I'm going to do, which is dollar cost average, invest in things I know, buy and hold low cost index funds and ETFs, and do nothing. And automate that whole entire process and whole entire systematic approach with my cash flow as well to get money into the market as much as I can for as long of a period of time, right? Well, triangle, invest as much money, contribution, and get the asset percent return, which is low cost index funds and ETFs are going to handle that part of it. If I can do that, and then lastly, I align my risk profile or my portfolio with my risk profile, I'm going to win the game big, because I'm going to be able to withstand the volatility, because the volatility is based on what type of portfolio you build. Tons of resources. Obviously, the Academy will handle this for you. I have a $7 investing resource to get you set up with your investments in the show notes below. $7. That will help you get your portfolio aligned with your risk profile, so you don't freak out about this question and you don't have to think you need a crystal ball, or you're not reliant on somebody's opinion like mine online, because you don't need my opinion. My opinion's ultimately worthless as far as that goes for the predictions of the future, because I can't predict the future. And I know that. And I know that limitation. But it doesn't matter if you do everything I just said. I'm also going to share some data and details with you, because that's what I do. So this is a very interesting statistic. In the last 40 years, the best 10 days out of more than 10,000 days, to give you perspective, very small percentage of days, accounted for almost 2/3 of the stock market return for the entire period. What does that mean in context of your question? You just said, should I move over to bonds? How detrimental that is to move during a volatile period is the definition of financial suicide. You are playing with fire, and you are going to hurt yourself so bad if you consistently move every time there's volatility in the market and you don't position yourself accordingly. This is going to be a very dangerous move that you make, my friend. And the reason I'm doing this podcast and I'm bringing up the data I am is because I don't want you to miss out on the 10 best days. And you might think, oh, well, I'm going to time it up perfect. No, you're not, because here's another statistic. From 1979 to June 30th of 2022, the S&P 500 had let's just say we put $20,000 in this investment in 1979. We let it ride for that entire period. We're talking 1979 to 2022. We're talking like 43 years. If I did nothing, I just did everything we just talked about. We dollar cost average, we invest in things we understood, we bought low cost index funds and ETFs, and we aligned our risk profile, our portfolio with a risk profile. If I did nothing, I would get about a 12% return. That $20,000 would have turned to $2.2 million. If I decided to get cute, if I decided to move things around because of the volatility of the market, and I didn't know what I was doing, and I was worried because I wasn't educated and I lacked resources, and I didn't invest in my education because I was too cheap to do so, which a lot of people were going to do and hurt themselves, I would lose $800,000. So you ask me, or you tell me, is the investment in your education today worth $800,000 to not miss the 5 best days, to understand what you're doing? I would say so, but you have to make that decision for yourself. The difference in percentage in that situation is only 1.5%. 11.59% to be precise in the beginning, stay the course. If you miss the 5 best days, 10.34%. All in all, you look at that and be like, oh, that's not big of a difference. It's an $800,000 difference, down to 1.3 million. Do not be that person. Missing the 10 best days during that 43-year cycle, you would have a 9.5% return, and you would have only 943,000, opposed to, if you did nothing, 2.2 million. 20 best days, 8% return, $547,000, opposed to 2.2 million. All of this is compared to 2.2 million based on how many days you're missing. You're missing the 30 best days. Now you have 341,000. You missed the 40 best days. And remember, a 43-year period, that's pretty easy to do if you don't know what you're doing. 223,000, missing the 50 best days, 150,000. And if you miss 60 best days, the worst one on this chart, that's a 3.96% return, and you only will have 103,000 after 43 years. So 20,000 would turn to 103,000 versus 2.2 million. When I say you're losing millions of dollars, I'm not kidding. This is one thing I find with a lot of people, of a monumental find of just staying put and being in something that actually aligns with them. They understand ETF, index funds, and DCA that will change their life by millions of dollars. 8 of the 10 worst performing days happened within 1 week of the 10 best performing days. You're not going to guess the right time. If you think you are, you're very egotistical, and I feel really bad for you because you're not going to win in life. Secondly, let's go through an actual market timing example by Charles Schwab. This will shock you. So they say there's much potential to lose money when market timing, meaning trying to jump around from bond to stock to this investment to that investment to not having an actual plan. You would obviously lose money if you have to sell stocks or other securities at a loss because the price fails to increase. But even buy and hold investors can lose money trying to time the market. Interesting. Charles Schwab ran a scenario, compared 5 different types of investors. It gave them $2,000 every year for 20 years, okay? It found out how much money they would have at the end. So this is really, really intriguing. An investor that had perfect market timing, literally spot on, basically God, had $151,000. They had $2,000 for every year for 20 years. So 40,000 turned into 151,000. Literally the most impeccable market timing. No human in human history has ever done that. Would have 151,000. An investor who immediately invested their money, they got the $2,000 every year. They invested, they didn't care. They just put it in the market and let it ride. There'd be ups and downs. They didn't care. Would have $135,000, a difference of like 15,000. An investor who performed dollar cost averaging would have right at $135,000. So they didn't panic, sell, they didn't care. They just put the money in as soon as they got it, consistently over time, just like we talked about, dollar cost averaging, and they had pretty much the same as impeccable timing. An investor with really bad market timing had $121,000. An investor who left their money in cash, which a lot of people do out of fear, had $44,000 at the end of that period. If that does not scream at you off the charts as to why I talk about what I talk about, I don't just say things to say things. I have the data to back everything I talk about, and it's a fundamental approach to building wealth. The reason we became financially free was because we did what I'm saying. I practice what I preach. That's what we do. Why do you think all my students have built significant sums, become millionaires, multiple 6-figure net worth increases? It's because they're doing this. It's because they're listening to the fundamental way of doing it. They're applying this fundamental approach, and they're building wealth over time, because this is what happens when you do this. when everybody jumps at everything that happens in the current environment, COVID, Trump's tariffs, election changes, presidential runs, presidents stepping down, everything that we've dealt with in the last couple of years, a lot of emotion surrounds that. But what really happens in the stock market is it consistently goes up and to the right with time. And if you position yourself accordingly, you're going to get really, really wealthy to where you won't ask me the question, is the market going to crash? And what's the best way to secure my investments? Should I move over to bonds? That question won't even be interesting to you. So when I see that, I look at this so differently. I think of all the potential that you really, truly have if you apply this. And if you look at the data, it just shows you individually what and how to build wealth. And I hope you take this today, and I hope you apply this to your situation, because if you want to begin building wealth, you need to start today in Budget Dog Academy in the show notes below. You need to go there, you need to apply, and you need to change your life forever. There's a reason students that come into the academy get the success they do, because they start applying the fundamentals and they put this into their life, and it's applicable to their situation. And it's very one-on-one focused. And when you take your life to the next level, you're going to win really, really, really big. But you have to stop asking these questions. You have to educate, and you have to prioritize this education as fast as humanly possible, or you're going to lose money. And I'll give you a good example as to what I mean by time and why this means so much. If I pull up a compound interest calculator and I show you the actual insights to this, let's say you have $100,000 invested, and let's say you're investing $2,500 a month. Now, everybody's situation is different. This is an example. And let's just say you do this for 30 years at a 10% return, average annual return. You would have $6.6 million, almost $6.7 million at the end of 30 years. Sounds good, right? If you wait 5 years because you're nervous, you don't think it's the right time, you're emotionally in your head right now, and you're justifying everything that you should wait, why you should wait, and you just wait 5 years, so you're doing that for 25 years, you will have $4 million. That's a difference of $2.8 million. Your decision to wait, the inaction that you're taking today, without taking action today, you are literally costing yourself 7 figures. And it's not even a debate. If you do not take action today, you are costing yourself 7 figures. Ask yourself, is it willing to invest in your education? Ask yourself, is it willing to start today? Am I willing to commit today, be intentional today, versus waiting or pushing this to next Monday, next month, next year, like everybody does in January 1st, which this year turned to January 6th because of the way the market or the days played out, which is funny. So ask yourself, are you willing to change your life once and for all? And if you are, do you know where to go? I'll leave you with that. And I hope everybody takes this to heart, because this is a big deal. And this is going to change your life in a sizable way. So I will see you guys next week.
You've been listening to Money on My Mind with your host, Brendan Schlagbaum. If you found value in today's discussion, share it with someone who could benefit from it too. Be sure to subscribe to the podcast if you haven't already, so you never miss a money mastery tip. Until next time, stay passionate about your financial journey and keep taking bold steps towards your money goals.